and also there are also some changes in the schedule 3 also. So there are various changes which we have to taken care while finalization of the corporate assessees, which we are now in the next 2 months we are going to finalize of all these audits. And one more thing is in this topic also there is the audit documentation that is very much relevant, because sometimes हम सब चीजों को ऑडिट कर लेते हैं, वहां पर देख लेते हैं, लेकिन व्हाट आर द टाइप्स ऑफ डॉक्यूमेंट्स व्हिच हैव टू मेंटेन टू फॉर द पर्पस ऑफ द पीयर रिव्यू और फॉर द पर्पस ऑफ एनी अदर इंक्वायरी बाय एनी अदर अथॉरिटी, सो दैट कि हमने जो चीजें ऑडिट की उसके लिए किस डॉक्यूमेंट्स पर हमने बिलीव किया और किस तरीके से हमने कोई ओपिनियन फॉर्म किया, दैट इज वेरी मच रेलेवेंट। और हमारे आज के स्पीकर्स चोपड़ा सर और अर्चना मैडम इस बारे में भी डेलिब्रेट करेंगे। तो नाउ नॉट टेकिंग वेरी मच टाइम, आई इनवाइट सीए ज्ञानचंद मिश्रा जी, फाउंडर ऑफ दिस ज्ञान की बात चैनल, टू स्पीक फॉर 2 minutes। ज्ञान जी।
थैंक यू अंकुर भाई, highly respected past president of the Institute of Chartered Accountants of India, and of course a visionary leader we have seen and a mentor and guide to me, C. Amarjit Chopra sir, very respected C. Archana Bhutani madam, for your kind consent to join the program, and of course today's guest of honor C. S.N. Kapoor sir, Lucknow se, my elder brother C. Ajay Kumar Mishra ji from Varanasi, today's moderator of the program Vibhor bhai from Raipur, and of course invitees from different destination of the region and of course the country. I can see in the picture my brother Abchal Kapoor ji, very worthy son of a worthy father, as well said S.N. Kapoor sir, and Abchal Vyawaj, past secretary of CIRC. I can acknowledge the presence of some very senior chartered accountants who have joined, Anup Jairat ji, Anurag ji, Ashish ji, B.N. Mishra ji, my partner Dipankar ji, Jitendra Mohan ji, Rohit ji. I can see that a lot of people have joined the program. So friends, I will not speak much about the topic. At the outset, I am really feeling very greeted that despite of so much odd situation and health issues, Chopra sir has joined us. So sir, I heartily welcome you from core of my heart. I welcome अपना मैडम। कभी-कभी क्या होता है, कुछ मतलब एक इच्छा हो दो मिल जाता है, आज मेरे साथ वैसे ही हुआ है। We were just aligned to listen our past president. Now we are just here to welcome Archana madam, and we will be listening her also. So well said by Ankur ji. Basically audit is not everyone's cup of tea as of now. हमारे दो इंस्टीट्यूट के बड़ी धरोहर चोपड़ा साहब और आहूजा जी को जब भी मैं सुनता हूँ तो एक चीज दोनों का कॉमन हमें लगता है। आहूजा साहब हमेशा बोलते रहते हैं कि अब सुधर जाइए, और चोपड़ा साहब हमेशा ये बोलते रहते हैं कि दिस टाइम हैज कम व्हेन वी हैव टू इंश्योर द बेस्ट ऑफ आवर dedication and devotion if we are doing assurance books. So audit is back. Now if we go some time back, we used to see that taxation, all those eras were very prevalent, but nowadays again audit is back in some other structures, others name forensic audit, transaction audit, internal audit, all those things. So my request to all the participants would be that we must take due learning from this session, and we must take home something today. Not only learning, कुछ हम ऐसा सीख के जाएं। अगर एक भी चीज हम इन लर्नड स्पीकर को अपने लाइफ में अडॉप्ट कर पाते हैं तो आई थिंक वो हमारे लाइफ में काफी दूर तक हमें समझ देगा. So by these words, I will not take much time. I request C. Ajay Kumar Mishra ji, my elder brother from Varanasi, to kindly say few words to start with the program. Then I will request S.N. Kapoor sir. So Ajay bhaiya.
Okay, thank you, Gyan. Respected CA Amarjit Chopra sir, past President ICI, SN Kapoor ji, Gyan ji, and all other dignitaries. We all are here gathered to learn and to educate ourselves. अगर हम लोग देखें तो world is changing very fast. We all are a part of the world, and accordingly, we have to also face the changes. In economic world, compliance requirement is changing very rapidly. We chartered accountant, as an auditor, have to report that auditee have complied the compliance requirement or not. Further, when acting as an consultant or any consultant to any organization, then also we have to explain and educate to our clients about what compliance requirement is there and how this will be implemented in the organization. But before that, we ourselves must have knowledge about these compliance requirements. Then only we can report or advise our clients. Further, we have to adopt continuous learning. Today's session is very important. Today's session is on very important topic, which we have to apply in coming days to conclude our audits. Thus, Gyan Ki Baat is playing a very good role in knowledge development of chartered accountant and as well as other professionals. Today, we all are very excited to hear the Amarjit Chopra sir on the such important topic. एंड डॉक्यूमेंटेशन की हम लोग बात करें तो आज की डेट में जो प्रॉब्लम हमारे लिए हो रही है ऑडिट के केसेस में कि इन मैक्सिमम केसेस व्हेन वी आर गेटिंग पेनलाइज्ड ड्यू टू नॉन मेंटेनेंस ऑफ द डॉक्यूमेंट्स व्हिच आर रिक्वायर्ड टू बी मेंटेन्ड, वी ऑल आर डूइंग वेल, बट ड्यू टू नॉन मेंटेनेंस ऑफ अकाउंट डॉक्यूमेंट्स वी आर गेटिंग पेनलाइज्ड. तो अमरजीत चोपड़ा सर हैं, इससे अच्छा कोई स्पीकर इस सब्जेक्ट पे हो नहीं सकता है और उनकी बातों को हम लोग सुनने के लिए आतुर हैं. इसलिए फर्दर विदाउट टेकिंग एनी मच मोर टाइम आई कंक्लूड माय वर्ड्स. थैंक यू.
So thank you, Via, for your wonderful words. And now I request a very senior member from Lucknow and like a mentor and guide to us, SN Kapoor sir, to bless with his kind words.
Thank you, Gyanji. I'm honored to attend today's Zoom meeting as guest of honor on recent changes in disclosure requirements of Schedule 3 vis-a-vis audit documents and presentation. The evolution of financial reporting is all good news, but it is not the end of the story. Financial accounting and reporting remains the core tool of entities for communication with its stakeholders. The last decade has been transformational, both in sense of enhanced awareness of corporate governance and has also large failure from a lot of elements of the system. Since then, the user's expectations from financial statement and audit report thereon have undergone a sea changes. From a time where concise financial statement and crisp audit reports were favored, the trend now is clearly toward more disclosure and transparency in financial statement and audit reports with more details. We, the chartered accountants, were saddled with additional work with the introduction of CARO 2020. Most of us think that CARO is very punitive. A lot of representation said that why an auditor had to report on something that the management was not reporting. So the ministry was quick enough to react and they introduced amendment to the Schedule 3 of the Companies Act 2013, which has fully transformed financial reporting, in my opinion, to management reporting. With ever increasing stringency in the regulatory framework and disclosures requirements, under various provisions of law, cartload of amendments in Schedule 3 have been brought to bring more transparency. By providing for various disclosures, including dealing with stock of companies, details of corporate social responsibility, cryptocurrency, etc., etc. The additional disclosures in Schedule 3, such as aging of trade payables, aging of capital work in progress, disclosure receivables, etc. Regarding title deeds of immoral properties not held in the name of company, and financials ratio would improve transparency and will prove to be useful in financial analysis. Certain disclosures are required in Schedule 3 in an attempt to curb money laundering, such as details of Benami property held, relationship with the stock of companies, disclosures related to conduct lending and borrowing, and details of categorizations as a willful defaulter by any bank of financial institutions. With the introduction of CARO 2020, there is an increased responsibility on the auditors to disclose and require details as mentioned in the order. However, all such information can be extracted from financial statement. Therefore, it was important that the financial reporting framework is aligned with the reporting under CARO 2020. Accordingly, the necessary changes were made in Schedule 3 to the Companies Act. Since an auditor is required to issue a true and fair view on the financial statement, the additional disclosure in Schedule 3 will form part of the financial statement and hence will be covered by the auditor's report. The amendments will also be, for sure, would curb the problem of inadequacy of information in the books of accounts of the company. Changes in financial reporting has led to change the way we do audit. We ought to have more comprehensive and technical team. Various processes are supposed to be built within one audit cycle. Lot of standards of procedures and proper documentation would be required to discharge our responsibility as auditors. I'm sure the participants will gain knowledge and skill from the deliberation of this seminar. Lot of thanks to the organizer of this Gyan Ki Baat seminar. Thank you.
Thank you, sir, for your enlightening words. And of course, the way you have briefed the entire session at the outset itself is certainly going to be a good pave to path for the members who have just attended the program. So I will not take much time. Ankurji, we should start the session immediately. I request Vibhorji to kindly moderate the session and start immediately. Thank you, sir.
I welcome all the attendees, all the speakers, both the speakers and our guests of honor today. And I would only say one line, one thing, that change is the only constant we have. And the other constant is C.A. Amarjit Chopra sir, who is regularly here with us for sharing his deliberation and on the topic. So I invite and hand over the mic to C.A. Amarjit Chopra sir.
Thank you, Vibhorji, and thanks to Gyan Mishraji. And my, I think, greetings to Shri S.N. Kapoorji, the senior member of the profession, Ankur Tayalji, Madhurima Sethi ji, whom I can see, and Ajay Mishraji, and many others whom one can view on this screen. And of course, my co-speaker, Archana, who has been a lender of the last resort, let me put it that way. I had not been feeling well, so I requested her that she should join. Of course, I can tell you that there have been programs in like Meerut and other branches where we actually did this particular session together, because I perceived far more interactive than being theoretical in nature. But this time, actually, I have to be really grateful to her for acceding to the request at a very, very short notice and saying, okay, we'll go ahead with that, because I know the kind of busy schedule that she has in her daily routine. Friends, so far as this topic is concerned, I think one thing that I would like to say is that I think the word is said that change is the only constant thing in the life. And this is also a change. But unfortunately, these changes have been brought in more from the angle that we have been inconsistent in our performance. We may or may not agree to that, because we don't want to concede this particular point that we have been inconsistent or we have not been performing up to the mark. But the fact of the matter is that somewhere or the other we have been erring. We have not been really performing to the extent that we should be performing. As I go along the various clauses, I'd like to tell you that why these clauses have come. Because luckily or unluckily, let me put it this way, when Mao Karo was changed to Karo, I headed that particular committee of the government. And when this Karo committee has come, then also I have headed this particular committee as chairman of this committee. But I will also tell you that, and I think Archana was also a part of that particular committee, which has prepared this Karo in the revised schedule 3. It was we, not any representation from anyone else. Let me be very clear about it. That we suggested in the committee. As a chairman, first I said, and then all other members actually agreed to it, that we expect auditor to perform certain things. But why not to expect management to disclose certain things on their own? Why only to hold auditor responsible for all the ills? Why should not the management make certain affirmations or confirmations before any action is to be taken by the auditor for that matter? And I think that was heard by the government very, very, but probably the amendments have to make these affirmations, and that is how the revised schedule 3 has come into play. I'll come to some of the very, very major clauses, but I will only like to tell you, again I repeat at the cost of repetition, Karo 20 or the revision in schedule 3 is our own doing. It is not the doing of anyone else. It is the doing of the management. It is the doing of the auditors. Let's be clear about it. The Boos have said that management reporting has come in. To an extent, yes, there is no doubt about it. I have heard some of the speakers saying somewhere in some of the circles that this report is atrocious and probably it was not desirable. The auditor has been voted. I've always said one thing in all my lectures every year. If we don't do certain things and someone else will force us to do it, it will all the more be unpleasant. And I think Karo 20 and the revised schedule 20 is one of those examples. It is not that everything we were not supposed to do what has been said in the Karo. In the existing Karo, in the revised schedule 3, as per the various auditing standards which we have, we were supposed to do which we did not perform. And when we did not perform, the government has come down and said, no, you will have to do this. And today we find ourselves in a position statement or a positive statement, and in certain cases with also. And if you don't do it, probably something is going to happen. See, don't you think that essay 40, we have been reading absolutely differently than what it was meant for? All refer to, even before the disciplinary committee and other places, we come to refer to Kingston Morton Mills case. BCom in 1971. I think others, let's be very clear about it. And if at that time it was said that auditor is a watchdog, not a bloodhound, can it hold good today? As before said, that change is the only constant thing in the life. We have to change with the changing times. If we keep on saying that auditor is only a watchdog, not send even alerts, forget about the bloodhound. I think we have to be at least barking dogs, that we can send certain alerts to the shareholders, to the various stakeholders, that whether the things are going wrong or right with the organization. They only on the LinkedIn, one balance sheet of one of the largest groups, not large, the largest group of the country has been shared by one of the gentlemen. The share capital of the company is 7 crores. The reserves are 374 crores. The borrowings of the company are 1,000 crores. I don't know what to expect and what to say. I don't know what to talk of the banking system, what to talk of the auditing system. Is it not essential for us to send some kind of an alert as to what is the debt in that company then? How it will service the debt? 1,700 crore rupees plus capital, 374 crore rupees of the reserves, 52,000 borrowings. What are we expecting it from? Yeah, I don't have to comment upon it, and how do they meet? I to think of. It is 23. The bankers never bothered about it. Tomorrow people will be bothered about it. People will be questioned about it. How did it happen? So what I am saying is, somewhere or the other, one needs to be bothered about. And I am only saying because this information has been shared on the LinkedIn by a chartered accountant. And I personally feel that the information that he must have shared is correct one. I'm basing entire my and I don't think it surmises and conjecture. If tomorrow this bubble gets burst, then will everyone, including the bankers, not get the blame for this?
Sir, your voice is...
People will be getting the blame for it, including the auditors for that matter. My humble submission to the auditors is, and I think the CARO and the revised Schedule 3 are in that particular direction, that auditors will have to act at least as watch, if not as bloodhounds, at least as barking dogs, who can send the alert signals to the various stakeholders. If the chief is entering, at least the dog will, he may not bite him, but he will bark at least. He may not be in a position to bite him because he's still outside. He will definitely bark. So I think the similar role has to be assumed by us as the auditors. And if we don't do it, somewhere or the other, each one of us will have to pay the price for it. The profession on the whole will have to pay a price for it. You see, so far as the CARO is concerned, it was notified earlier on 25th February 2020 to be implemented from that particular year, effective 1/4/2020. Then it was postponed because of COVID twice. And then ultimately it has been notified on 17th 2020 in the present form, effective 1/4/2021, which means that the accounts which have been prepared and audited, which means that the accounts the financial statements which are based upon the accounting year beginning on or 1/4/2021 will have Caro 2020 and the revised schedule 3. This is very important to be understood, because what is happening is I should not be applying
Sir, there seems to be some voice issue, Chopra sir.
year begins on 1st January 2021 and close on 31st.
Sir, there seems to be some voice issue. Chopra sir.
Over to device boss. Just you can take over. Archana.
Sorry. Let me just, I think before I just add my comments, I think the last point that Sir was making, let me complete that. I think he's on the point that please see which is the relevant Caro to be
You can take over,
applied.
Archana, from here.
So let's say if you're a December year-end company, December 2021, then Caro 2020 may not be applicable. So look at the applicability and then just see whether the pre-revised or Caro 2020, which one is applicable. That's the point he was making in the last bit. So just look at your year for which this is being applied. I think if I can just add a comment or two to the general comments that Sir made. I think when you look at Caro focuses more on propriety matters. It talks about governance, compliance, and that is why you'll see it keeps on changing. You don't have you had some clauses earlier, they were taken out, they've come back, and so on. So why does this happen? Because the intention of the regulator is based on the way they see the transactions or where the areas of concern or focus are, those get incorporated in Caro. So for example, whether short-term funds have been used for long-term purposes and so on, so which is indicative of a solvency challenge. Now, given the number of companies which have recently gone into insolvency, I think they've considered it appropriate to bring back. So if you look at it, they go beyond what is your true and fair, right? Many of these items will go beyond your true and fair and require you to look at maybe governance matters and propriety matters, like I said earlier. And I think to the point that Sir was making in terms of, what kind of a dog is an auditor, but I would actually just say that, it sounds very cliched, but what works is actually the thing that is really needed is professional skepticism. I think if you do approach the audit with professional skepticism, look at the transactions, question their economics or business rationale, I think you will, or many of these things will anyway get identified. So I think that is extremely critical to move away from just a checklist approach to really, really kind of understanding the substance of the transaction. So skepticism, I know we talk a lot about it, but I do sincerely believe that it is really required, at least, I mean, I would say it's always required, but at least in the current times, and especially given the focus of the regulators. So I don't know whether is Sir back or should we?
I'm back. I'm
okay.
back.
Okay. So Sir, I completed your point on the applicability that I've already shared. And do you want to now move on to specific clauses?
No, Jai, I'll take another 2 minutes before I really move on to that. And the schedule 3 has been revised, and all the 3 divisions have been revised, if you really ask me. And this notification was given on 24th of March 21 for the changes which have come in. Now, one thing is that so far as the applicability in general is concerned of Caro, it's more or less whatever was earlier. It is not applicable to a banking company. It's not applicable to an insurance company. It's not applicable to a company which is registered under Section 8 of the Companies Act. It is not applicable to a small company for that matter. And it is also not applicable to a private limited company if all the 3 conditions are satisfied at the same time. Even if one of the conditions is not satisfied, the Caro 2020 becomes applicable in that particular case. The 3 conditions are: number 1, if your paid up capital plus reserves are up to 1 crore rupees. In that particular case, it will not be, you will not be hit. But at the same time, then another two conditions will have to be satisfied by you, that your borrowings on any date during the financial year should not exceed 1 crore rupees. And then your turnover during the year should not have exceeded 10 crore rupees at any point of time during the year. I think that's very important. If all these three conditions are satisfied simultaneously, then it is not applicable to such companies, such private companies. But if even one of the condition is not satisfied, in that particular case, it will become applicable so far as Caro 2020 is concerned. Now, I will try to give importance to some of the clauses which are going to hit us very adversely. And the profession will be hit quite badly by that, in the sense that we have not been doing that, and probably now expecting us to do that may not be very easy for us to perform. And probably we'll have to convince the clients, but the clients will have to be convinced, because that's a part of the revised schedule 3 also now. Because CFO will have to confirm it, the directors will have to confirm it, the audit committee will have to confirm it. It's not that it's only we who are responsible now. One of the things which has been said in property, plant and equipment is, number one, if property, plant and equipment has been acquired either through the purchase or through the amalgamation mergers, in that case, this bifurcation has to be given separately. Let's be very clear about it. Because if you purchase something, it is different. If you acquire something through amalgamation, it is something different. And the other thing which is required to be done is that if at all you revalue your any assets, and the difference between the earlier carrying value and the presently stated value is more than 10%, in that case, that has to be stated. First, it has to come through the revised schedule 3, and then in Caro, the auditor will have to comment upon it. And another comment that the auditor will, firstly, the management will have to make, and then the auditor will have to make, whether the revaluation has been carried out by a registered engineer or not. On what basis you have carried out this revaluation? Whether it is because based upon the valuation by a registered engineer or your internal working. Because the reader of the financial statement has a right to know, it is believed, that whether the valuation has been done properly or it has not been done properly in those cases. So I think this is one of the questions which has been first asked in the revised schedule 3. The management will have to affirm it, and then it will come to the auditor in Caro, and in Caro, the auditor will have to answer this particular question. The other thing that that has been asked is, in how many cases of the property, plant and equipment, and when I talk of this earlier evaluation, this 10% difference is not an overall basis of the total assets value. No, it is based upon the class of assets, whether it is building separately. Building, if it was carried at 1 crore rupees earlier and now it is carried at 1 crore 8 lakh, I don't bother. But if it is carried at 1 crore 12 lakh, in that particular case, it will be, it's the, you can say the class of the asset, which is important. Similarly, in the plant and machinery. So it is not the total asset size, which has the difference of 10%. It is the respective class of asset. If it has got a difference of 10%, in that case, this particular clause will become applicable. The second thing is, what is being asked is, whether in respect of property, plant and equipment, there are any such assets which are actually appearing in the balance sheet of the company, but are not having the title deeds, but the company does not own the title deeds thereof. So why this law has come in? First, we must, if we appreciate why the clause has come in that case, we will never forget the clause. Let's be very clear about it. See, it has happened in some of the cases that partnership firms are converted into companies. No, in the partnership firms, the asset is not in the name of the firm. The asset is in the name of the partners. The asset continues to be in the name of the partners. When the company became, when the partnership firm was converted into a company, the assets remained in the name of the partners. And few of the partners I will not like to say assets and different background whose name the property is, in whom the assets are. So those partners who had actually become shareholders, the property had started appearing in the name of the company, did not convey to the company that they are selling out the asset, but sold out the asset and pocketed the proceeds. And similarly, there were certain things with regard to amalgamation and merger also. And of course, in the case of amalgamation merger, these kind of fraud may not have been possible. But then the other concern was that the title deeds were never got transferred in the name of the company. Now, the question which has been asked is more serious. There is a format which has been given. Let's be very clear about it. The format which has been given is very clearly asked you which class of asset is not in the name of the company, what may be the value thereof, and also at the same time whether any of such assets is in the name of the directors, key managerial personnel, relatives, or any staff member of the company. This is something which is very serious, or the relatives of these people. Why this question has come in? Because when you transferred the assets basically to the company, at that time these assets were being held in the name of someone else, and you have not got it transferred. Now, this person could, the government's implication is that it could be a Benami transaction also, something else also. And there are possibilities of the fraud also in these cases if the title deeds are not in the name of the company. So now the question which is being asked particularly is that if at all this is, the title deeds are held in the name of the directors or substantial shareholders, or in the name of the relatives thereof, or in the name of the key managerial personnel, or in the name of any of the staff members. There are companies where the properties have been held in the name of the PMs or certain other persons. Now, these are all questions which have been asked. And the other implication could be, very frankly, when this question is being asked, when you are going to transfer this property to the company, what will be the value of the stamp duty in those cases? Whether any stamp duty implication will be there or not. And if at all the stamp duty implication is going to be there, whether that liability is being taken care of or not. These questions require some kind of consideration by each one of us. Let's be very clear, so far as this particular part is concerned. Because it is not that the frauds didn't happen. Frauds did happen, and that is why these questions have come in. Firstly, this question will be asked in the revised schedule 3 from the management. Management will disclose that, and then auditor will be required to comment upon it. Archana, if you will like to supplement it.
So I think you've covered it comprehensively. I think just to add to the point you made in the beginning, which I totally agree, it's important to understand why each of these changes have been introduced. And we'll find some relevance to the kind of transactions that the regulator is observing. And the theme, just to add to what you just said, the theme seems to be, the related party transactions, the diversion of funds. And in diversion of funds, I will include these assets as well that you spoke about. I think that seems to be an area of focus. The other area of focus, if you will see, of the regulator continues to be in terms of solvency, going concern, and so on. So these are, and the third is, of course, more of compliance related matters. So that seems to be, and these are all coming from actual issues or situations which the regulator has seen. These have just not been added. So I think your point in terms of really appreciating why the clause has been added. I think in terms of this specific clause, the PP, I think just to reiterate 1 or 2 points in terms of identifying the title deeds, you're absolutely right. The focus, because the focus was more on diversion, and that would typically happen when the property is held in the name of director or a employee or a relative of so and so. So I think that is the reason why that information is being sought. That clause was there. I think now to kind of make that distinction between genuine cases wherein, let's say there's been an amalgamation, but the process of transfer of ownership is still, legal ownership is still in progress. So I think they've made those distinctions, and the intention is to really identify those transactions which are cause of concern, and that is the reason that specific information has been sought. Like I said, sir, you've covered it comprehensively. Just one point which I would like you to, I know we've discussed it earlier, but it'll be good to have your inputs again on this, is that when we talk about registered valuer, there is, based on my interaction, I've seen many just see it as a as something which is preferable but not necessarily required. So they feel that if the registered valuer hasn't carried out the revaluation or fair valuation, you just simply state so. I think this this clause in a way is bringing up the fact that if you do have a situation where this revaluation was not performed by the registered valuer, somewhere it would be not considered to be really in compliance, because if you look at the Companies Act, it does require that wherever a fair valuation is required, it should be carried out by the registered valuer. Now, one may take a very hyper technical argument to say, this is under the standards, not under law, but the standards are also under law. So I think just taking it from my past discussions with you, just want to reiterate, I do feel that the concept of use of registered valuer does seem to get neglected at times. And maybe you may just want to mention a few words on that.
Very frankly, Archana, I always go by the intent of the law. I never get into the lines of the law. Let's be very clear about it. And I think whatever discussion took place on the table there, in which you are also part, the intention is very clear that if registered valuer is not doing it, where is the reliability, where is the credibility of those figures? I think that's very important. You are doing something wherein transparency is lost, the credibility is lost. I don't think that will justify that. So I think if I go by the intent of the law is that we have to do it and we have to get it done by a registered valuer. And I personally feel, that's my gut feeling, I may be wrong, let me put it this way, that wherever we will write or the management will write, it is not done by a registered valuer, the notice will definitely come to you wherever some scrutiny will take place on the part of the ROCs or somewhere else. I am very clear on it that if at all accounting standard prescribes it, it is a part of the law. You cannot say that it is not mandatory. Then it becomes mandatory because accounting standards are a part of the law today. And to the extent that it goes on to say very clearly when we look at the Schedule 3, that wherever there are requirements of the accounting standards will override even some of the requirements of the Schedule 3 for that matter. So Schedule 3 will not be dominant. If there are additional requirements of the accounting standards, those will be predominant basically in those cases. So if it is to that extent that the accounting standard has to take a front seat rather than a back seat, in that case, how you can say that we will not get it done by a registered value? So that's the way I will look at it.
Maybe just moving on to the next one, sir, on the inventory
Yeah.
head.
Yeah,
I think, yeah, so the first bit is that while we always had this clause which required us to comment on physical verification, now CARO requires the auditor to specifically comment whether the coverage and procedure of verification is appropriate. And if you'll recollect earlier, the clause said if there is a material discrepancy, which has been noticed on physical verification, it has to be, you had to comment on it. Now, the past experience was that this material, what is a material discrepancy? This was, there was a lot of diversity in the way this term was being really interpreted, and many instances probably were not getting reported. So to take away that judgment and to bring in that consistency, now CARO requires, it has actually stated, it's removed the reference to material and stated discrepancy of 10% or more for each class of inventory. So not even total inventory, for each class. I think that's been really, I think this should be helpful, like I said, because the way it was interpreted earlier, it did kind of, in many cases, lead to many instances not getting reported. The second one, sir, is the more critical one. I think that is where maybe we can discuss a bit, which is where the company has been sanctioned working capital limits in excess of 5 crores. And the focus is again on sanctioned working capital limits. It is not on actual utilization. And the second bit is that this sanctioned working limits has to be seen at any point of time. So it need not be throughout the year, etc. So if at any point of time, the company has sanctioned working capital limits in excess of 5 crores in aggregate from banks, financial institutions, on the basis of security of current assets, then the auditor is required to comment whether the quarterly returns which the company has filed with the bank or financial institution is in agreement with the books of account. And I'll just quickly give a background, sir, and you know more, you can then add on. Again, going back to why this was really introduced. So it was seen that there were instances where, let's say, instead of submitting the return as at the end of the quarter, let's say 30th June or 30th September, the company would submit the return as at 25th of June, which will have a lot of discrepancy. Maybe, I mean, you know, the 25th of June statement may justify your DP limit, but when you actually look at the inventory as at the current assets as at 30th of June, probably you have exceeded your DP and so on. So I think there were instances which were noticed that the statements which are being submitted to the banks or the financial institution, they really did not give the right picture in terms of the, to assess the drawing power. And there was, and that is why to kind of identify those instances, this clause has been introduced. So I think 2 or 3 things here. One is this applies only for quarterly statements. So even if your loan agreement requires you to submit something every month, you don't need to cover that. It is only, the reporting is only on the quarterly statement. And the second bit which I like to mention is that when they're talking about whether these returns are in agreement with the books of account, here I like to just talk about what is really expected of the auditor. So it is not just a simple tick to the ledger to say, okay, this is what is the balance in the return in the statement filed with the bank, and this is as per my books. It is not even expecting you to do a full audit every quarter for this statement, but I think the answer is somewhere midway, to say you at least do some procedures to be able to get some assurance on whether the information which was submitted to the bank is reliable, because that is going to be the basis for your drawing power. So let's say if, maybe it could require use of internal control, some kind of an analytical review. So more than just sticking to the ledger, and maybe not really as exhaustive as the audit, but carrying out some procedures to get a comfort on that.
Thank you very much, Archana, for your inputs. I will again go back to the members. This is something that I have been saying in various bank branch audits, that whatever is being done, we have to be careful, and I think we have read SCP 40 absolutely. We always keep on saying that unless I stumble upon some kind of information, I'm not supposed to detect any fraud. Fine, agreed to that extent. But you tell me, if a company is enjoying a limit of say 50 crore or 15 crore or 20 crores, and you know that after you will be going through the agreement of that particular loan, as an auditor, you can't do everything the agreement. When you read that agreement definitely says that the company will be required to submit these documents to the or statements to the banker. No, is it not my duty? It's a very simple question that I'm asking to myself. Is it not my duty as an auditor that I have to make sure that the company has complied with the terms and conditions of that agreement also, and if they have complied with, whether this is actually as per the books of accounts also or not? We are only referring to right now, you are only referred to the inventories part. Very frankly, it is not only the inventory, it is the statement of debtors also, it is the statement of creditors also. Because what is being asked by the question, both in revised schedule 3 as well as in Caro, is that if at all you have been sanctioned working capital limits beyond 5 crores or more, in that case, what is going to happen is that if at all there are certain covenants, there are certain stipulations by the bankers to submit some kind of returns. The returns can be on inventory, it can be on debtors, it can be on creditors, it can be on something else also. Now, if at all you have been asked to file certain things, whether those statements are as per books of accounts or not. No, the question that you raised, that instead of 30th June, I have been filing for 26th June, instead of 31st March, I have been filing on 28th of March. Fine. But we have also been told in our entire auditing procedures that there are cut-off procedures also. That reconciliation has to take place. I can't say that I will not be able to reconcile for 3 days or 4 days. There is no way that an auditor can get away with that kind of an argument today. Let's be very clear about it. And whatever has happened in the case of debtors or creditors, etc., I don't want to say anything because in every balance sheet, the creditors are triple the size of the creditors which are shown in the statements, and debtors are always lesser in the audited balance sheet. Inventories are lesser in the audited balance sheet than what have been shown in the statements. So I personally feel that somewhere or the other, we faltered, and the government has come down heavily now. Now the government says that first the management will have to certify, and then we will have to comment upon that. Basically, these are the requirements of the revised schedule 3 as well as the CARO, and I think it's not going to be an easy job for us. Most of us are going to say, sir, how will we do it? I think we will be able to do it, provided we have a will to do it. If we don't have a will to do it, we will not be able to do it. Let's be very clear so far as that particular part is concerned. Next one, Archana.
The next one I think is a critical one, which is on the loans, and I think that is what I was referring to. There have been many instances of diversion of funds, and especially within the group. So you'll see instances. Let's say company A gives loan to company B, B will give a loan to C, C will give a loan to D, and somewhere nothing really comes back. Okay, and you will see through the whole process, the funds have either gone to an entity which is linked to a promoter or a promoter group and so on. So there's been a lot of instances like that. And again, appreciate the changes which the CARO brings in that context. And I will also take another example. Let's say at times you make investments, you make an investment in an entity wherein there is no, when you look at the credibility or the financial credibility of the entity, you really actually don't see justification making those investments. I think that is where these questions are coming up as to whether these transactions being used as to siphon off, I'm just using a strong word, to siphon off or divert money to related parties, and that is what this clause intends to capture. So if I look at the first one, for example, we had a clause earlier which required us to see whether the company has, granted any loans to companies which are there in the register maintained under Section 189 of the Companies Act. Now, given the way these transactions are happening, the regulators kind of made this clause much, much more broad. It's focusing not just on loans, but also on investments, guarantees, securities, any form in which the funds can be funded, non-funded. And again, the scope of the transaction is no longer limited to parties which are there in the registered and maintained under Section 189, but to any party. So in a way, it is looking at, as you can see, all of your financing and investing transactions to kind of really understand how how these transactions are taking place. So if we look at these sub clauses within this, one is wherein just simply requires you to give you requires the auditor to give the aggregate of these transactions. I'm not going to talk about that. I think my concern is more on 2 or 3 specific aspects of some of these sub clauses. One is which talks about whether these loans are prejudicial, whether these investments, guarantees, securities, or loans are prejudicial to the interest of the company. Now, this clause was there earlier, but like I said, it's also expanded beyond loans to investment securities, etc. Quite often when we discuss this aspect, people feel this is more of a business decision. If a company is given a loan or made an investment, how can I really comment as an auditor whether it's prejudicial? It's a business decision. But I think that is where professional skepticism and really understanding the transaction comes into relevance. Now, if a company is giving a loan, let's just think about it. If I am not an NBFC, I'm not a banking company, I'm a manufacturing company, why would I be giving loans? I can understand giving a loan to a subsidiary because yes, I need to support my subsidiary financially. But if you see large number of transactions, let's say a loan has been given for 10 years or a loan has been given with no terms of repayment or a very low interest, wouldn't you just question why would a company make such a transaction? So I think that's what it gets you thinking, that if when we talk about prejudicial, of course, you would look at, is this a reasonable, sound business decision, a bona fide decision, a transaction for the company? And if not, then you look at it. So let's say, for example, I've given a loan, which is no terms of repayment, like I said, wouldn't you question that, especially if it is not to a subsidiary? Or you've given a loan, which is, let's say, at market rate of interest. Okay, below market rate of interest, I would clearly say prejudicial, but let's say it's at market rate of interest. The company would try and say, listen, this is to a party and I've a related party, but I've charged market rate of interest. But there, let's say if I was to look at the financial credibility, the market rate of interest is, let's say, 8%. But if that company had gone to seek a loan, then probably it would have got it at 12%. So why am I giving it at 8%? So it's not just about looking at it with the market rate in general. It is looking at, is it at arm's length when you look at the financial position of the counterparty? So I think these are aspects which need to be carefully considered. When you look at prejudicial or not, just simply, I mean, forget even any technicalities. Just put yourself in the shoes of the company and say, if I was in that place, would I have undertaken this transaction? If it means a loss for me, why would I do it? So, like I said, in some cases, like subsidiaries, etc., you can justify. But in all the other situations, I would be very careful. I would look at a wholly owned subsidiary different, consider that different to maybe a 60% owned subsidiary. Associate is different, and other parties, and especially when these transactions roll up into the purpose of the loan is, you also need to see the ability of the counterparty to repay. So let's say I'm giving it to company X is giving a loan to company Y. You also need to see what is it going to be used for, right? And because that would also give you an idea as to whether the company is using this borrower only as a conduit or as a channel to kind of, give money to the, to transfer funds to the promoter, or maybe it is itself acting as a channel or a conduit to just transfer these funds. So I think especially when you look at these business rationale of the purpose for which the loan is being given, the terms and conditions, that becomes very critical for you to really understand whether or not the transaction is prejudicial. So do you want to talk about this before we get into evergreening bit?
I would certainly like to say certain things. Archana, we have already covered it quite exhaustively, but I would like to say that, as you said earlier, these transactions are only, which were covered in Caro, were only in respect of the loan and advances. No investments and guarantees have also been taken into consideration. And it is up to the management as well as the auditor. First, in the revised Schedule 3, they have to comment upon it. And then in the Caro, the auditor has to comment upon it. Now, the point that one has to be very, very clear about is that if at all, I think the point that you have made out, if at all you are making certain loan to somebody, or you are giving advance to somebody, why are you doing it? And whether, or similarly, if you are making investment in a particular company, if a company is making already losses and is not ready to be revived under any circumstances, in that particular case, why are you making investment in that? You see, if it is your 100% wholly subsidiary, one can make out that it may be in the interest. It can be a case of your joint venture, it can be a case of your associate. That where probably these advances or loans could be seen in a different perspective, or investment could be seen in a different perspective. But if at all you are giving loans to certain third parties, you are making investments in third parties, the balance sheet of which, the financial statements of which do not give a very healthy picture, in that case, why should you be making investments in that? What can be the reason thereof? There are cases in this country where the private limited companies have been used as conduit to siphon off or divert the money somewhere else, basically. So I think that is one thing that we have to be very, very careful about. And I think the test that we have given is that if it was my money, take it that way, that if it was my money, whether I would have done it or not, simply because it is company's money, so it has been done. So I think that is very, very important test. That tomorrow, if somebody wants me to invest in a particular entity, should I be investing or should not I be investing? The other thing that one may like to say is that one very basic one fundamental question which has been asked, because we failed to report on that, very frankly, earlier. that whether there, firstly, it was already covered in section 143(1), if you ask me, under the inquiries. The auditor is supposed to make inquiries whether there are certain advances which are in the nature of loans. Now, I did not report. Maybe I didn't report on that, or maybe I could not fathom the idea why it should be done that way. But you look at a situation where a company with a turnover of 1 crore has been given an advance of 5 crore for the sale of for supply of goods or services to me. How will they do it? If the company's turnover is only 1 crore, how will they supply me material worth 5 crore, or how will they give me services worth rupees 5 crore? I think as an auditor, it will become imperative. I'm using the word imperative now, that if at all advance has been outstanding or advance has been given to certain other company, other body, and which is disproportionate to the other company's size, nature, and of the business. And the other thing that one will like to say is that why I should be giving something free of interest to somebody and let it be lying there for a period of 2 years or 3 years or 4 years? No way, because then it can only be in the nature of the loan. And the moment an advance is to be treated in the nature of the loan, you know what sections get attracted under the Companies Act. Because the Companies Act is very, very clear. For advances, certain limitations or certain ceilings may not apply. But for the loans, many other things will apply, that you cannot give any loan interest-free to any of the parties. Whereas the one distinction that I would like to make is advance always given for to be adjusted subsequently against the supply of goods or against the supply of services. Whereas loan is given to be repaid along with the interest, or the interest can be paid at different frequencies. So the moment you are giving an advance, it cannot be repaid to you. After all, advance has to be adjusted by way of the supply of the goods or services. And if every time it happens that you give an advance and it comes back to you, it is nothing but a loan. And then the rate of interest, etc., and other provisions with regard to giving the loans will definitely be attracted there too. I think this is one very, very crucial area, one very critical area which we have ignored all these years, which we may not be able to ignore any in this particular year now onward. And I think not only we, I think the managements have to answer this question. My only suggestion to all the members is, do not go by mere management representation. कि management ने ये कह दिया कि ये सब ठीक है, advance ही है. You will have to test the veracity of that particular management representation.
So,
you will have to, because even SA 580 says, you cannot rely upon the management representation on the face value. You have to test the veracity and accuracy of the management representation. So you will have to do that. That is one thing that I will definitely like to say here. And the other thing is that if the loans and advances are made, I think when you talked of evergreening, what is evergreening? I think one part which we have missed out is very, very clear. And I think the Institute's guidance note is absolutely silent on that. And I think if not today, tomorrow that is going to happen. Now the government will bring it somewhere or the other. This very clause also says that, number one, how many loans have been given as repayable on demand? After all, because you are expected to determine the, you have to find out what is the, what are the terms and conditions of the repayment of the loan or interest, and whether any amount is overdue or not, and whether any amount has been restructured to, and whether you see it as the evergreening of the loans. The point that I am trying to drive you home is, number one, because this format now very clearly says that you will have to give what percentage of the total loans is repayable on demand. If it is repayable on demand, then it means what kind of a financial planning you are doing, what kind of ALM you are doing, asset liability management. Basically, ultimately, you also have to match your assets and liabilities. You might have borrowed certain money. When the other money will come back to you, you don't know. So that's absolutely unacceptable situation to be in. So similarly, you have to determine conditions, and if you keep on saying it is repayable on demand, probably some of us were over enthusiastic in telling the clients that if you say it is repayable on demand, nothing will become overdue. I think we are caught in a web today. We are on a wrong foot. We have been caught on a wrong foot. Now, if 80% or 70% or 60% or 50% of the loans will be considered to be repayable on demand, which you are supposed to give now as a percentage, the total amount, and as a percentage also of the total amount of the advances. What is going to happen? I don't have to comment upon it. I think Archana may be better placed to comment upon it. And the other thing that one will like to say is that when we talk of the evergreening does not mean that when you restructure it after it becomes overdue. Restructuring would also mean when even it has not become overdue and still you do it. You see, if the other company is performing very well and you restructure and you give them the extended period, no issue. Absolutely no, not an issue. If their financial condition is not unstable, there is absolutely no issue, because even if you go to the RBI's definition of restructuring, it says where you grant extension, where you grant more time, where you grant certain concessions because of the financial difficulty of the other party, then it will be considered to be restructuring. That is the definition which has been given by Reserve Bank of India. Now, if the other company is performing well, they have the liquidity, but you feel that probably where you are going to deploy the funds later. So you say, okay, your period stand extended, it will not be considered to be evergreening. It will not be considered to be restructuring. But if the balance sheet, if the financial statements of the other company very clearly reveals that unke paas to paisa hai nahi repay karne ko, they are making losses already. So what do you do? And even if you restructure it before, I will not use the word restructure, even if you extend the period before it becomes due, it will be considered to be restructuring. Let's be very clear about it. And this question has to be answered both by the management as well as by the auditor. Yes, Archana.
Yeah, sir. I think absolutely fine. Just two things. I didn't really introduce the evergreening clause, so I will take them through a bit more in detail. But just going back to 2 points that you brought out. One was advance in the nature of loan. So I always thought this was covered, but yes, because it was not being reported, now the regulators, MCS kind of brought that in specifically. And just to take an example, in addition to what you shared, let's say typically one could be a situation like sir discussed, I've given an advance and it comes back. So the fact that the advance is coming back obviously shows that it's in the nature of loan, especially unless until you can really demonstrate this was a genuine case of a cancellation. But let's say I have situations wherein it is in advance, it will actually get settled against the goods purchased or services received. But the terms are such that it becomes a loan. So for example, generally the advance given is 1 month advance or a 2 month advance. But what you've done is you've given advance equal to 6 months, 10 months. Okay. The other example could be that typically you give advance equal to 20% of the PO, purchase order, but you've given 100% advance. So when you've got terms and conditions which are significantly a deviation from what you normally do, those are, I would say, the red alerts. You need to kind of see why is in this case did I give an advance which is equal to, let's say, more than what I normally do, or for a period longer than what I normally do. And those could also be instances which could become advance in the nature of loan. Because just think about it. What does it mean? It means you're just financing someone. If the supplier, let's say, doesn't have funds, and in a way I'm saying, listen, I will also give you funds, right? The services or the goods are going to come 6 months or 1 year later, but I have made the payment today. Is this not just financing? So to the extent it is in normal, 1 month advance, what the industry in that sector does, etc., you can obviously say, okay, this is not, and usually in those cases, it will not even be material. But the minute you deviate and it's material in terms of timing or the amount, it requires consideration. The second bit, I just wanted to share one example in terms of prejudicial. And again, this is not hypothetical. This is exactly how transactions have happened and how management may I'm not saying deliberately, very unconsciously also, they may not realize So let's say let me take a case. You've got a common promoter. That common promoter has two subsidiaries, subsidiary 1 and subsidiary 2, right? Now, subsidiary 2 is a 100% subsidiary. Subsidiary 1, let's say it's a 60% subsidiary, right? Subsidiary 1, which is a 60% subsidiary, is cash rich, it is profit making, whereas subsidiary 2 is loss making. Now, promoter tends to, there is this tendency to feel both are my companies, So what if I give money from one to the other? They genuinely feel that there is no issue in that. But just think about it. When you have taken the funds out of that subsidiary 1, which was just 60%, you had outside interest of 40%. Now you want to protect your 100% subsidiary. You have given loan from subsidiary 1 to subsidiary 2 because you feel, yes, you like to protect your subsidiary, right? But just think about it. For the 40%, interest owner, they may not, their interest obviously gets impacted prejudicially because you've given their funds to an entity which may actually have no capacity to repay. For the promoter, he may feel it makes no difference, but for that 40%, it makes that difference. So when you're looking at commenting on whether or not it's prejudicial, don't think, oh, ultimately there's a common promoter. When you talk to the management, they will tend to really genuinely think, why take a loan from outside? I had one subsidiary which was cash rich, I gave it to the other. But you'll really need to see, should you have given, if you did, I'm not saying you never give loan to a loss-making entity. If you did, what is the kind of security did you take? What is the interest rate, repayment terms? What actions did you take to follow up on recovery and so on? So I just wanted to put that, and I'm talking about very practical scenarios, not just theoretical, but where you really look at this. In terms of evergreening, I think when you look at the clause, because evergreening is a term which is not defined anywhere. So Caro attempts to kind of, without defining it, capture its essence by saying that if you've got any loan or advance in the nature of loan, which has fallen due, but you have renewed it, or you have extended it, or you have given a fresh loan to settle the overdue of existing, then it requires you to report those. So effectively, what are the two concerns if you see here? I wouldn't even, actually, they're not two. I would say actually one concern. Effectively, you've got a loan which is bad. Probably you will not recover. You should have probably booked some ECL, some kind of a loss against it. But what you're doing is by renewing, extending, or just doing this in form, you are trying to make it appear as if it's a good loan. So one is you're not giving the right picture of the nature or the health of your assets. And secondly, through this, you're avoiding any loss which needs to be recognized. When I'm saying avoiding, I'm not saying as in a correct planning. You're actually, the loss has occurred, but it is not getting recognized. So when you talk about renewal, I think that is where the point that Sir made becomes very relevant. Now, let's say I had a 3-year loan and I renew it at the end of 3 years because the party doesn't have the ability to repay. Very clearly you report. But the issue is that nobody really waits for the 3 year to get over. They will typically renew it a month, 2 months, 6 months in advance. They will agree. And that is where I think Sir was mentioning that these are instances which probably do merit reporting, but the ICI guidance note is currently not very clear on this. So I think you should really see why the renewal has happened. Is there a justification? Is it that the project is getting, you're expanding the scope of the project. The other is to say the project for which the funds were given are not really doing that well, etc. Just see what is the focus. Is it that somewhere the loan has become bad and it is just to avoid that recognition you're reviewing? I think that becomes very critical. Similarly, extension has the same impact. The loan was due in 3 months instead of, I just extend the repayment dates. It's the same thing. And fresh loans granted. Now, quite often it may not be so apparent. Quite often these restructuring or evergreening may not be so straight. So let's say I have a loan which is repayable in 5 years. It had an interest rate of 10%. So what I do is that in the second year itself, let's say the borrower is not even able to service the interest. So I say instead of 10%, give me 2% interest rate. I restructure. And the difference between this 2 and 10, which is at 8%, I take it as a bulk payment at the end. So I say, okay, whatever is the difference, I add an installment at the end of the term. Effectively, that is also nothing but, in a way, what you've tried to do, renewal and extension. It can happen in various ways. It may happen that instead of, let's say I had given a loan of, let's say 5 crores. the party is not able to repay. I give another loan of, let's say, 7 crores. The amount is different. You may think these are amounts are not tying up, but the 7 crore is given on the understanding that the party will first repay the 5 crores. Okay. So in a way, you're doing nothing but circulating the same money, right? So there could be, just be very careful in terms of what is the purpose for which the funds are being given and whether the funds are actually being utilized. When we discuss this quite often, we hear this, how would I get to know how the fund has been used? Once I've given the money, how do I know what the counterparty is doing with it? So please note that under section 186, you are required to disclose the purpose of the loan. So very clearly, you will have, when the loan is given, you will know what the loan is given for. You can, as the auditor of the lender, you can ask them to seek a certificate from the borrower to say, listen, this is what was given. Give us a certificate whether the funds have been used for those purposes. I would also acknowledge that despite this, there can be challenges because quite often you'll have situations where the purpose of the loan will be written as general business purpose. So it will not even say whether it's for capital expansion, some capital asset, etc. But I think that is where we need to kind of probe a bit more to understand what this was given. And the minute you can see some kind of, look at when new loans are being given round about the same time when loans are due for repayment, question that, right? There can be many, many structured transactions also, like let's say that I had given loan to company A. It doesn't have the ability to repay. I give a loan to another entity, which will further transfer the loan to entity A, and then I get my loan back, So at times it may not be, you may even have a third party being involved and so on. So every time you have every financing, let me just put it like this, every loan transaction, you should question the purpose for which it is being given. The minute you'll question where the funds are being utilized, somewhere you'll be able to make a trail. Because as auditor, our biggest worry is how will I know the trail once the money goes out? And that you can only do once you question the purpose and you seek confirmation about its utilization. Sir, I'll hand over to you to add.
No, I think the points which you have raised are very, very valid. And I will only like to say one thing, that today, the responsibility has been passed upon the auditor to seek confirmation that if at all you have given certain loans to somebody or you have invested certain amount somewhere, how these amounts are going to be used. That may not become an intermediary for the final actual destination to somebody. Now, Rule 11E has come in, wherein the auditor is supposed to get the confirmation. Believe me, the auditors don't get the confirmation now from the parties which took the funds. No, this confirmation has to be given by both the parties which have given the funds as well as the parties which have taken the funds. They will have to confirm that they have taken it for the specific purpose, and that specific purpose is not to make any investments on behalf of this particular company. That nowhere ever the company which is giving the loan or making investment said something very specifically that these funds have to be utilized in a particular manner by the person who is receiving the funds. If the purpose is there, probably it may attract certain different things for that. I don't want to get into the details thereof. But believe me, my own version is that we will have to be extremely careful so far as this particular part is concerned. I think Archana has explained everything very, very nicely so far as this particular part is concerned, but I will only like to say, please follow Rule 11E under all circumstances today. As an auditor, it is a part of, not Caro, it's a part of my main report now that I will have to confirm it. I think that's more important. So that's one change which has taken place under 143.3 for that matter. There are three very significant changes in revised schedule 3. Now, one question which has been asked, I don't know how, is what is the applicability of the revised schedule 3 to the non-corporate entities? I don't know how to answer this question. If these are non-corporate entities, where is the question of revised schedule 3? This is the schedule 3 which is applicable only to the companies. Let's be very clear about it. But the non-corporate entity, where is the question of the applicability of the schedule 3? So I think they should satisfy the person concerned, whosoever has asked this particular question. One question which has been asked now in the revised schedule 3, but the auditor will have to examine it from a different angle. The three questions that I am going to raise now, these are not there in Caro. These are there in the revised schedule 3. Number one, what it talks of is, in the case of the trade receivables, earlier we used to give the aging. What was the aging? The aging was only less than 6 months, more than 6 months. It says nothing doing here. What is this meaning of less than 6 months, more than 6 months? Give us 6 months to less than 6 months, 6 months to 1 year, 1 year to 2 years, 2 years to 3 years, 3 years and above. And there also give different different kind of classifications. Whether the amount has been disputed and considered good, or whether the amount is not disputed and considered good. Of course, secured, unsecured is a different matter altogether. So the point is that if an amount has been disputed, it's for a period of 3 years, it has been outstanding, and you still say no provision is required. All these things are going to come back on you now, because all these years we have not taken care of these things. That we only talked of less than 6 months, more than 6 months. Now, very clearly, it wants to find out from you if a particular trade receivable has not been received for a period of 3 years and it is not even disputed. What kind of a trade receivable it is that no, you are not disputing it, he's not disputing, but he's not paying it, and you still consider that it is good for recovery. All these questions are going to be asked. Disputed, undisputed, and where these are undisputed, different kind of examination by the auditor. If these are disputed, different kind of examination by the auditor. Then a very serious question has been asked, which was never asked earlier in the revised schedule 3 from the management. Trade payables aging. Similar thing. Again, whether trade payable is for a period of less than 6 months, 6 months to 1 year, 1 year to 2 years, 2 years to 3 years, and 3 years and above. Now you start looking at it. We have not ever commented upon trade. Very frankly, even if these have been outstanding for a long period. Now, what makes it very imperative now to test it? If a trade payable is outstanding for a period of 3 years and the amount is huge, which is that person, which is that party which will leave you without taking the payment? I think the moment now, there are going to be bigger amounts for a period exceeding 2 years. Why to talk of 3 years? Suppose your policy is to pay off your creditors or trade payables within a period of 45 days or 3 months or 4 months, and you have not been able to pay somebody for a period of 2 years or 3 years. Is it not giving you some kind of suspicion with regard to the genuinity of that transaction in the earlier years? To my mind, yes, it should. It should give you some kind of an inkling, and that is what the professional skepticism would mean, very frankly. No, these are the questions which are going to be asked, and believe me, I'm not saying it otherwise. The moment now the income tax authority, because this classification will come, this aging has to come from the management itself in the revised schedule 3. When they are going to see that there are huge amounts of trade payables have been pending for a period of 3 years, 2 years, there could be further scrutiny of this. And what that scrutiny would lead to, I can't, I don't want to comment upon. So be cautious as auditors to what you are going to do to this trade payables. Non-MSME. All those different classifications have to be given. Another point which has been raised there is, which the management has to give in the revised schedule 3, is with regard to the capital work in progress. Because what has been happening is we have been showing capital work in progress. How old it is, we are not commenting. And probably the managements were going on capitalizing the interest cost, the salary cost, the other administrative overheads to this capital work in progress. Suppose certain asset was to come into existence within a period of 1 year, and for last 3 years this asset has not come into existence, and you are still showing it as capital work in progress. Can you capitalize all these overheads? There is no way that you can do it, because that's as per the standard. That's as per the standard. You just can't capitalize all those costs. And if at all it comes to light now, and now if the capital work in progress has been there for 3 years, 5 years, 6 years, whereas it was supposed to be completed within a period of 1 year or 2 years, you should be asking for the test of impairment in those capital work in progress. Why not? And if we have not, my professional skepticism has taken a back seat, and it has gone for a toss. So all those things are going to be there now. And then there is a question to the management, in how much period you are going to complete this capital work in progress, 1 year, 2 years, 3 years. And then you will have to test it as auditors, whether there is likelihood of any cost overrun, and if there is going to be a cost overrun, how much capital you have committed to that. All these are the alerts which will be sent to the readers of the financial statements. Let's be very clear about it. On these 3 points, Archana, anything that you would like to say?
So, sir, no, I think very valid. And I do recollect when we first started talking about revision to Caro, you were the first one who had mentioned this aging of creditors. And I thought about it, that why we have never thought about it earlier. It is very important, and please just don't see it as a number, this thing, okay, this is the aging. In terms of what sir was explaining, I think it does talk about the financial health of the company. If you're not able to repay your creditors, let me not even say repay, if you're not able to pay your creditors, it does indicate. And similarly, the issues with capital work in progress. So one is the issue of just capitalizing costs which shouldn't be during the extended period. That could be one concern, but then there could also be that why is the company not able to complete it? Is it that company has some challenges? It could be operational, it could be financial. What is the reason why the projects are not getting completed? And it isn't to say that every time just because a project is getting extended, it is bad news. No, not always. Like I said earlier, also it could be the company's decided to extend the scale of the project. That could be for, it's doing a much higher level of investment is proposed to be made. So I think, but it does, these are indicators, or these are the issues that you should still look at. And if I can just connect this to Caro, okay, so I'm just going just a bit ahead, because I think most of the information in Schedule 3 is also linked to how it will help the auditor under Caro to make their comments. I would also like to link the points that sir made to the comment on, which is clause 19, again, a very important one, which focuses on solvency. So it says, on the basis of financial ratios, aging, expected date of realization of assets, etc. And all those things are the information. Effectively, it requires you to see whether there is material uncertainty that the company is capable of meeting its liabilities existing at the balance sheet date when they fall, as in when they fall due within a period of 1 year. So I think this is where they're kind of getting a sense of the solvency. So the matters that sir spoke about, I would look at the creditors aging. I would look at why are the projects getting, extended, etc. So those issues we really go into commenting will be relevant when you make your assessment for the purpose of clause 19. So don't look at them as just, information which is just included in Schedule 3, but there is a relevance because it gives you a much wider picture of the operational or financial challenges that the company may have. And if I can just add at this stage, when we talk about this clause, it is, many think it's the same as going concern, not necessarily. Going concern is a much wider assessment that you're making. This is, when you look at going concern, it could be that I'm financially solvent. I have huge cash surplus, right? I have a huge cash balance, but I don't have any business. So am I a going concern? The answer is no. This one is not really asking you to comment on going concern. The focus is more on your solvency, more on your liquidity in that sense, your ability to meet your liability. So see it from that perspective. And so I thought I'll just connect the points you made to clause 19.
I think very well done, Archana. I will only like to tell them that there are about 11 ratios which are sought to be calculated today. Firstly, the management will disclose those ratios, and then the auditor has to look at those ratios, and then he has to make sure that the numerator and denominator have the same components which were there in the last year also. It should not happen that last year current liabilities had different components, current assets had different components, this year these have different components for that matter. The other thing that one will like to say is that one has to be very, very clear on one point. That a better current ratio may not mean that everything is good, because higher debtors, higher stocks could be spelling a problem also for the organization. But I don't want to get into that. But based upon these current ratios, based upon these ratios, in Karo, we are expected to comment upon. As the company will be able to meet its current liabilities, that is, which will arise in the next 12 months. That will move away from being just a test from an attest function to someone who can actually foresee the future of the company also to an extent based upon the ratio. The ratios will be provided by the management. We'll have to check these ratios, the accuracy of those ratios, and then comment upon that, what Archana has actually said. But to me, there are certain other questions which are very, very crucial and which are going to be troublemakers for us. One of such questions is that if at all the company has surrendered any income or any investment or anything during a raid or otherwise, search, seizure or चाहे वो सर्वे है या सर्च है, सीजर है या assessment के दौरान, if the company has surrendered certain things, how that has been accounted for, or if there has been certain seizure of certain assets, etc., how that has been accounted for by the company. I will just raise one issue and then I will ask Archana to comment upon it. There have been cases where people have been surrendering cash credits. That okay, these cash credits we are unable to explain this, and this can be deemed as the income of the company. There have been cases where the share capital of the company taken from various people was surrendered, saying that we can't prove the source of this share capital. You treat it as income. Or if the stocks have been surrendered somewhere, the GST people come and they conduct the survey and you say, yes, our stocks are excess. And that has to be treated as income, then how do you actually account for that? Similarly, if certain GST people come or income tax people come and there is some unaccounted for cash and you surrender that, how you are going to account for that? This was never asked to you earlier. Now suppose in the notes the management is disclosing that we were raided in any of the, will you not like to go through the Panchnama, what they have surrendered, what they have not surrendered? I think all these questions are going to arise now. This is something which is absolutely new. Firstly, the management will have to give it in the Schedule 3. And then as an auditor, I will have to comment upon it, whether that accounting is correct or not. This is a major challenge for the profession. Let's be very clear about it. We may not like it, but that's the way the things are there today. Then there are Benami transactions. Now, firstly, the management will say that whether any proceedings against them has been undertaken under the Benami Transactions Act or not. So management would say, no, there is no Benami transaction, there is no proceeding against me under the Benami Transactions Act. But when you are going through the various legal expenses or professional charges, you come across that certain bill has been paid to an advocate. It says for appearing before for the case of the Benami transactions. What do you do? In Karo, you will have to comment upon that. And the format has been given that if at all you have some kind of proceedings under the Benami Transactions Act, what kind of information you are supposed to give. It will say what is the total amount, what is the kind of asset, what is the kind of what is the amount, and since when it has been held, in whose name it has been held. All those details will have to be given by you. Because if those details are given here, those details will be taken care of by the assessing authorities in income tax and otherwise also. See, one thing that I can tell you now, this Caro will be made use of not by the bankers only. This Caro will be made use of significantly by the assessing authorities also, even under faceless assessment. Let me be very clear about it. Then there is a question with regard to that whether your company is having certain transactions with the companies whose names have been struck off. क्योंकि अगर आपको याद हो, when on 1st January and 1st July 2017, the Honorable Prime Minister came to the meeting of the Institute to introduce GST, for the introduction of GST in the country. He announced that several lakhs of companies' names have been struck off. And after that, the names have continued to be struck off for various reasons. Now, if you have got certain transactions in the company with the companies whose names have been struck off, take the case where you have made investments in such companies, or take the case where you have taken certain cash credits or loans from such companies. Take the case where there are certain trade receivables from those companies. Take the case where there are certain trade payables from these companies to these companies. I think as an auditor, you will have to make assessment about how to really look at those kind of transactions. How to account for those transactions. If a company's name does not exist anywhere today and it has not been distributed by the company and you are showing trade payable there, whether that company actually, whether that is actually the trade payable or not, or if you are showing a trade receivable and that company's name has been struck off, will you be able to receive the amount? These are all points to be pondered over by the auditors. All good thing is that firstly, this information has to be given by the management and then has to be commented upon by us. That's a good thing. So that but at the same time, the management will continue to say, no, sir, we don't have. But if you scan through the list of the struck off companies, it is not going to be an easy task. And you find that there is one company whose name appears in your trade payables or trade receivables or investments, you will have to take your own view in that case. And the accounting will undergo a change so far as that particular part is concerned. Archana.
So, sir, I think you've picked up two of the clauses, at least, which I was hoping we'll get to, which is the undisclosed income and struck off. I think they're very, very important. On the first one, sir, if I can, at least given my interaction, I feel on the undisclosed income, I do feel there is some bit of a gap in terms of how these are really accounted for. So if I can take the opportunity to discuss that. Now, when you have these situations of undisclosed income, this rate being done and so on, quite often what the company does is just passes the entry for the tax. So they said this was the rate, this was the cash which was identified. They'll recognize the cash and then they will make that payment. Now, is that good enough? So that's the whole question. Is that the appropriate entry? Now, there I'll just like you to think about it, that just think about it. Why did the company have this cash? Which means probably they had some transactions which were not recognized in the books. So if they've got cash, which means this is somewhere net surplus, let's say you would have purchases, you would have made sales, all of these would have been outside the book and you have some cash at hand. Now, what typically the authorities do, to the extent they found cash at hand, they found cash balance in the rate. So they will also kind of extrapolate and kind of work out, the income that they may assess maybe more than just what the cash balance that was found there. Now, let's say they have added, the cash found was, let's say 3 crores, but they add an income of 10 crores. So how do you really do this? So just passing the entry for 3 crore cash and the tax to be paid is not good enough. You will need to recognize that income as well. Now, the minute you recognize the income, the question comes, where is the other entry? Because you're recognizing income of 10, let's say you're recognizing a cash of 3, then where does the balance entry of 7 go? So you will also need to recognize some debit. Now, the company will typically say that, listen, obviously, if there was cash which I had, I've also used it for official purposes, and they would like to recognize this as purchases. Now, we do not really know how much was really used genuinely for purchases or how much was siphoned off, right? It could be that some cash may have been taken away by the promoter or by an officer or whosoever. So it is very difficult in the absence of any evidence to really say that this was purchases or a bona fide expense. So I think while that, yes, debit would have to be recognized, but classifying that as an expense, like a purchase may not be possible. So the appropriate nomenclature clearly bringing out, this is an expense for which the underlying evidence is not available. That kind of a disclosure would have to be made. So just the point I'm trying to make is just don't stop at making the tax entry. That is what I've usually seen doing. You would also have to make an entry for the income. And of course, given the double entry concept, you'll also have a debit being recognized, but that will be an unsubstantiated debit. Quite often companies say that I'm even contesting the income, but you're recognizing the income, then you also recognize purchases. But to the extent the authorities have blessed the determination of income, I'm not going to question that. They would have done a thorough review of the documents. They would have asked the company for, all the relevant evidences. If after that they have assessed the income, I'm not going to dispute that. But I can't accept the corresponding amount just to be a purchase in the absence of any evidence, because if there was a genuine purchase, the authorities would have also allowed it. So if the authorities have identified income but disallowed expenses, those expenses cannot be blessed by the auditor. So I think just looking at how this entire bit is accounted for becomes critical. I would distinguish this from a scheme like Vivad Se Vishwas Tak, wherein when you look at the terms of the scheme, they acknowledge that by using the scheme, the company is not in a way accepting that, there was undisclosed income, nor is the authority accepting the position of the company, etc. So in a way, it's like saying, without prejudice to the position each has, this is like a settlement that they've come at. In those situations, of course, you may just recognize tax. But if it's a raid kind of a situation, I think the accounting would be different. That's just what I wanted to add. So struck off company, you've covered very well. And I think, again, struck off company becomes a cause of concern more because, again, it has been seen that it's been used to divert funds. Now, you could have genuine situations wherein, let's say, when I transacted with the company, it was not struck off, but I still had balances recoverable 6 months down the line. It got struck off because of liquidity issues. That's another thing. But I think the concern of the regulator is more where this has been used. And generally, when I say that when you will use a struck off company, usually it will be for a transaction which will not be in compliance with laws. So I think that also throws up some concern.
Well, thank you, Archana. I think we have covered all important aspects, if you really ask me. The only thing that I would like to say is that when you talked of extrapolation of certain income, what I'm saying is that to my mind, you can see that the wording used is where surrendered. I think that's very important. If it has not been surrendered, then we don't have to. I think where we acknowledge, yes, it is so, there the problem arises. If I'm disputing it still, they might keep on extrapolating it. I'm not bothered about it. I think I'll keep on showing it as a sort of a contingent liability so far as that particular tax part is concerned. So that is where I will like to end up on. There are certain questions with regard to cryptocurrencies. There are certain questions with regard to CSR that I think people will be able to handle. I don't find anything unusual in that. First, the management has to disclose and then the auditor is supposed to comment upon. Then, of course, the utilization of funds. Whatever loans are taken, particularly for the short-term purposes, should not have been utilized for the long-term purposes. Whatever loan amounts are taken for the purpose of from public issue, either of debentures or equities, have been used for the specified purposes. These are all the questions which are there. So I'm not too worried about these questions, but whatever were the major questions, I think we have been able to handle, unless you have something else in your mind.
No, sir, I think this is fine.
Because the number has already started dwindling. It came down from 100 to about 72. So I don't want to keep on talking to a level when only two of us would be left in the audience.
Sure.
So thank you very much, Gyanji and Vibhorji, and of course all the listeners. And if at all there are questions, we would like to take those.
Yes, sir. There is one question. Will extension of loans to increased period will be treated as restructuring?
Yes, 100%. That is what the restructuring is. That is where you are allowing him the evergreening. provided whatever Archana has said, and I also said it. You see, under RBI also restructuring is when the other company is in a financial difficulty and you allow more time.
Yes.
If the other company is not in a financial difficulty and you are allowing more time because you want to deploy your funds, then it is not restructuring. Then it is not evergreen. That's very important.
Yeah. And if I can just add a point here, at times it may be a specific extension, okay? And at times it can be implied. So let's say the loan has become due, but I'm not saying anything. I'm neither renewing nor trying to recover the money. That is also an implied extension.
Okay, I think that is the answer to the question, and I find no other questions there. So I think we would end our session with a vote of thanks. And I would like to thank our today's speaker, C. Amarjit Chopra sir, C. Arjuna Bhutani ma'am, who has wonderfully conducted this seminar on this topic, which is of great importance now. And this is the burning topic which every practicing chartered accountant would require this. So I would like to thank again all the attendees who have come here, and I'm sure they have been enlightened by our distinguished speakers on the topic. I would also like to thank our organizing team, Gyan Ki Baat, CA Gyan Chandra Misra ji, CA Ankur Tayal ji, CA Puneet Sakuja ji, for their continuous effort to conduct such wonderful seminars for the benefit of the members. I thank all. Thank you.
Thank you very much, Vibhor, and thank you very much, Ankur ji, for organizing this.
Thank you, sir. Thank you. Thank you very much, sir. Thank you very much, madam.
Thank you.
Thank you. Okay. Thank you, Archana, from my side as well.